Hello, hello, hello. I am super, super excited to be here today because I will be talking about one of my favorite things on earth, and that is how do you, as a business owner, keep more of your money, especially when you are a high earning individual. I think sometimes we get caught up when we're making six and seven figures and we feel like taxes is just part of the thing. And yes, it is because we legally we're gonna pay our taxes around here. But oftentimes I have found that clients are overpaying by 10, 20, 30,000 in taxes every year. That adds up over time. And there's actually a study that actually came out that 93% of business owners are overpaying on their taxes, and it's on average of $12,000. That's a lot of money, right? What would you do with an extra $12,000 this year? So much, so much. Maybe it's finally hire that assistant you've been trying. Maybe it's put more money into ads where you can really grow and expedite your business. I remember I did a tax intensive for a client and I was able to save her $24,000 in just 1 year. She actually used that money to reinvest into the business via ads, and she went on to triple her revenue. So these are things that happen when, yeah, you have more money to play with. You get to decide what you want to do with it. So I'm gonna start sharing my screen here in just a second. Because one, this is going to keep me honest because sometimes I will go off on a tangent and y'all don't need me on a tangent. Y'all need me right here with you talking about the stuff. So yeah, this is all about today's masterclass information session, whatever you want to call it, is about eliminating the blind spots that are costing high earners 20K or more in taxes each year. And this is really geared towards six and seven figure service providers. You're ready to keep more of your money and send less to Uncle Sam. Because I tell people all the time, they F up their money. They don't know what to do with it. So don't you dare go send them an extra dollar of yours. Okay. With that being said, let's jump right in. Okay. So welcome. I would love to know, and you can DM me, shoot me a message, comment, what, however you want to do it. But let me know which one are you. And if you're multiple of them, hey, listen, that's fine too. There's no issue there. But um are you one, you're pretty sure you're overpaying in taxes, but you have no idea where to even start. So you just keep putting it off, a little bit of avoidance going on. Are you two, you've always trusted your accountant to handle it. You hand over the numbers each year, cross your fingers and hope it's right, but deep down you're not confident that it is. So that's some discernment. You're already feeling in your gut that, ooh, something is off. Or are you three, you feel frustrated that you make good money, but it never seems to stick. You can feel there's a leak somewhere. You just can't see where it's coming from. So you're more frustrated, like, I make all this money. Why does it have to go there? I need to figure this out. Or are you four? Are you someone who the IRS scares you and you'd rather overpay than risk owing? Like you're just like, I don't want to owe the IRS. Like I don't want to in trouble with them. If it means I'm overpaying, I don't care. Even if you know that means that you're leaving thousands on the table. And here, this is not a judgment zone. This is just to really check in and see where are you at. Five, you've never really understood your tax return. You get the email that it's filed, but you couldn't explain what's actually happening with your money if someone asks. Like you're just a little unaware, or maybe it's something that caused you confusion or angst or whatever, and it's just not something that you've sat down and said, okay, I want to understand this. No judgment. Are you six? You wait until tax season to even think about taxes. Every year feels like a scramble, and you tell yourself next year will be different. Anyone? Or seven, you know you could be more strategic, choosing the right entity, documenting your deductions properly, having your bookkeeping in order, paying yourself better, but you never had someone walk you through what actually makes sense for you. Is any of that, do you fall in with any of those? Just put that in there. And I want you to know that if any of that is familiar and you've already identified where you are not alone and you haven't been doing it wrong. You've just never actually had someone sit down and explain things to you and actually support you and create systems that actually help you navigate the way to do it the right way. And that is what's often leaving you overpaying by tens of thousands of dollars. But luckily, but today I'm going to cover some of the top four mistakes that I see, the blind spots that's really costing the bulk of the cost that I have when I actually go and I'm doing my intensives and working with my clients in a one-on-one capacity, because people just don't tell us what we don't need to know. I'm just quickly talk about who I am for a little bit. I'm Alex Davis. I'm a CPA, which is a certified public accountant. I'm a certified financial planner. I'm a licensed life insurance agent as well. I'm a two-time best-selling author. One of the books is not on there. I'm Sarasota Chamber Minority Business of the Year finalist. I'm a graduate of the Goldman Sachs program. I'm a girl mom. I have two girls. One is 21, one is 7 at the time of this recording. And last year I saved my clients an average of $21,000 between doing the annual tax prep or either me during these intensives. I'm a Virgo sun. Go Virgos. Shout out to my Virgos out there. Gemini moon and Cancer rising. I just like to share that. But I actually spent over a decade in public accounting, and I primarily work with high net worth individuals and small business owners. And that was my niche. And when I tell you high net worth individuals, I'm talking about people who wrote the IRS $17,000 check. $17 million, $17 million checks to the IRS for the taxes they owed. And this is after extensive tax planning. This is after structuring and having multiple, you ever see those diagrams where people have all these different entities and like trusts, single member LLCs, partnerships, S Corps, all the things. Those are the clients that I work with. And so I've always had a different approach when working with clients because I got to see what the top 1% were doing with their money. And they always had the best accountants. They always had people working with them and for them to make sure that they are covered. They did not leave this up for chances on their own. They didn't. And that is something that, and we'll get into that, but that is like one of the biggest things that I noticed. And I'm so grateful for my time in public accounting because not only do I have that really strategic mind, but I also know how they think and what works and how they've been able to have multiple generations of wealth because they have their taxes is a major focus of how they spend their time and money and making sure that they are not overpaying and they're being strategic. Let's see. Okay, perfect. So here's going to be the flow of how I flow through all of this with you. First, it's really going to be about awareness, really spotting the hidden money leaks, also blind spots that's costing you every year. And then also seeing where and getting you to see and think about where your numbers may be off and why that is. So you can actually start doing the number 3, which is learning simple shifts to stop overpaying. And then at the end, I'm going to offer an invitation to you because if you are someone and you're watching this and you're like, I feel like all of those are happening in my life and I actually need to know how bad is it impacting me? What is it costing me? How do I fix it? That's what we do in the intensives that I work with clients on. And if that sounds good, I'm recording this so y'all can't give me a thumbs up, but we're gonna keep on this train on moving, and we're gonna jump into the blind spots because I'm not here to have you all day. I'm here to give you this information so you can actually take it with you to implement. So the first blind spot that costs clients, I kid you not, anytime I've worked with the client and we've identified that their entity is wrong, is usually $25,000 that we end up saving because of the amount of income that they're producing. And that's in 1 year. So think about that. $20,000 over 5 years is $100,000. You could buy some real estate with that. You know what I mean? So wrong entity structure. And what that can really look like is you set up your LLC when you started and you never revisit it. You're just like, oh, I just had my LLC and now it's 8 years later and you're making 6 figures net income and you're still in a single member LLC. It could look like that. And it could look like you're paying more self-employment tax than necessary. So that may look like, why is my tax bill so high? Why is my effective rate 40% in tax? This doesn't feel right. I need to review this. And it could also look like you're unsure what the differences really mean for your business. What is an S Corp? What is an LLC? What's a C Corp? What's a partnership? What does it actually mean? And I'll quickly just do a high level. I share here, you'll see this picture where it's a C Corp, S Corp, LLC, partnership, sole proprietor. And in the middle, there's that LLC thing. And we love an LLC, right? Everyone talks about an LLC. You're not taxed as an LLC. And that's what I really want you to really think about and remember is if you are an LLC, you're not taxed as an LLC. You have to tell the IRS how you're taxed. And you're either going to be taxed as a sole proprietor if it's just you. If there's multiple individuals, then you'll be a partnership, unless you make an election to be a C Corp or an S Corp. And you have to actually make elections to do that. And there are pros and cons for each. And so you need to really understand as far as what are the benefits for tax benefits, what are the benefits for ownership transfer, what are the benefits for getting funding, what are the benefits for bringing on more individuals into the business. You have to have an idea of what makes sense for you and your business and your goals when you're picking this. And so it's not just that I want to save on taxes when you look at your entity structure. You want to take a holistic approach and look and make sure that you are considering everything with that. Because when you're in the wrong entity structure, not only is it going to cost you taxes, and it most certainly will, but it can limit your overall growth. And that could cost you even more money in the future. So for example, if you are a sole proprietor and you have an opportunity to have someone invest in your business, but they're saying, hey, I actually want a piece of your profits, and it makes sense, right? All these things make sense. A sole proprietor may not be the best avenue for you, in addition to the fact that of the self-employment tax. So, as your business scales, you really want to consider, am I in the right entity structure to make sure that you're not overpaying or setting yourself up for limited growth? And I'm going to share some stories of clients where they were in the wrong entity structure and what we did, and then just give you some tips for what you can consider when you're thinking about, okay, is this the right entity or not? And so though, and like I said, when I said what it could look like, those are just some of the things. But yeah, it could look like not being able to grow your business and scale the way that's most optimal because you're not in the right entity. So client C, we're going to call them, because I'm not going to, I work with clients, and at the end of the day, I'm a CPA, I'm a certified financial planner. And so the work I do is very sacred. And I also have a fiduciary responsibility to my clients. And so I'm not sharing their names here. But I had one client who she thought she was a single member LLC. And by thought she was, that's how she had been filing. She had been filing, and that's what was going on the tax return. But she was actually partnering with her spouse. And so it was two people. And as an LLC, you are actually not allowed to file just on a Schedule C as one person. There's a thing called a joint venture. But when you make the LLC election, that's not allowed anymore. And so because of that, they were, one, in violation. They should have been filing the partnership return, but they were only filing on the personal return as a Schedule C. But also they were overpaying in self-employment tax, because with the two of them, based on their income, they should have been in an S Corp to save on taxes. And the other thing is because her husband actually was not listed on the account and he was actually doing the bulk of the work, he was not showing any income and not paying any taxes. And what that looked like is he's also now not getting credits for Social Security. And some of us may say, well, I don't know if Social Security is going to be here. Look, we don't know, right? But based on today, Social Security is here, and he was not getting any credits for it, and he should have been. So that is a big issue. And I uncovered all that during my review and my assessment. And so I share, you're overpaying self-employment tax and you're risking IRS issues, because the other issue is they were set up as a two-member. And let me tell you something about the IRS. The IRS may be late with figuring stuff out, but they eventually do. And they will send notices saying, hey, you didn't file your partnership return. We're missing this return. It's late, and you have to pay X amount of penalty, which is, I believe it's either $195 or $295 per month per partner / shareholder if you're an S Corp. And then they cap it at a certain amount. But either way, that's a lot of money that adds up, in addition to interest and penalties for not paying it. So you see how being in the wrong entity, I just said a lot. Did that feel overwhelming to you? I need to take a breath myself, because that was a lot, but that's what happens. And so what was the fix that I gave them? Clarify their ownership so they could be in the correct structure. And then we started properly filing the partnership return for the next filing. Now, in their case, we ended up making the S election and saving them more. But this was just doing this was a $5,000 tax savings, and they're avoiding future IRS red flags because now they're properly actually set up. And so what I want you to do is your takeaway. And you're like, oh my gosh, well, how do I even begin? I don't know if I'm right entity structure. Review your ownership structure every year. Like every year when you sit down, and I would recommend don't wait until tax season. Do it by the end of the year. Like November, December is the best time really to do tax planning because you can take a moment to look back and see where are you at for the year. And then you can start doing projections for, okay, the last couple of months of the year, what do you project your net income to be? So you can get an idea of, okay, where's my income at? Is this the best entity structure based on my income limits? Am I checking all the boxes to do the things to make the proper elections? And then most importantly, is your current structure serving your goals for growth? Because like I said, it's not just about taxes. You have to consider other things. Are there other planning opportunities that your current structure are not allowing you to have? And if your answer is, I don't know, which most likely it is because you're not an accountant, you're not a tax strategist, you're not the tax professional, is to get with someone who can actually help you answer these questions, who can look at your information and answer these questions and get an understanding of you, your business, your goals, and where you want to go. So that way you can actually get guidance that makes sense for you. And with that being said, we're going to jump on over to blind spot number 2, which is improper or inaccurate bookkeeping. And this is the one that takes most of my people out. Bookkeeping isn't sexy, right? And probably some would say tax returns aren't sexy either. Actually, bookkeeping, because some people say it's tedious, it's time consuming. Like, who wants to do bookkeeping? I received that for you. I received that. But you still have to do your bookkeeping. You have to do your bookkeeping. And when you don't do your bookkeeping, this is what it could look like. Your tax return may say one thing, but if we actually pulled up your financials, it would say another. Or you wouldn't even have financials. If the IRS came in and said, prove to me that what's on your tax return is what ran through your bank accounts, and show me your financials, that profit and loss, that balance sheet statement, you'd be like, I don't know. And the IRS doesn't like that. They want something called substantiation. So should you ever come under audit, they're going to want to know, hey, where did you get these numbers from? So it could look like that. It could look like your income is overstated, and sometimes your income is, understated depending on the errors because of accrual entries, undeposited funds, just completely improper bookkeeping, lack of bookkeeping, just things that just got missed. And then oftentimes it could look like you're not reconciling your accounts monthly. So errors start to just continue. And by reconciling your accounts, we're talking about your bank statements, your loan statements, your credit card statements, things like that. Those should be being reconciled monthly so you can know that what actually happened on the cards and the accounts, on the loans, is actually what's being reported in your financials. And then I have another client D. And in this client situation, as I was reviewing everything, because he was really concerned about, I was like, I feel like my taxes is really high. I don't understand. Like, I didn't have that much in revenue this year. I actually was doing a lot of different types of transactions. So I didn't have that much money. And as I actually started going through and looking at his financials and me having listened to him about him closing on properties and him getting investors, I realized, oh my gosh, $100,000 of income should have been classified as a loan. And so what happened is sometimes bookkeepers will, and not all the time, but sometimes you're just looking at their bank activity and you're recording the transaction. You see income come in, you assume that it's revenue. And if you don't either ask to and confirm what type of activity is this, you could have it incorrectly posted. And that's exactly what happened. And so, and this was causing him an extra $30,000 of tax because he was in 30% effective tax rate. So had I not caught that error, he would have been owing the IRS an extra $30,000 in taxes. And so what I had to do was, one, we acknowledged it, right? We fixed it. And we were able to reclassify that income to actually be a loan. And then we started reconciling the ending loan balances and making sure that our balance sheet was accurate, because that was the problem. Because the loan was misclassified as income, it also meant that there was a loan that he had that was not showing up on his books. And that was actually going to lead him to, in the future, probably missing out on interest expense, because it's like, okay, Well, there's no loan, so we may not be picking up the interest expense. And then again, just having an inaccurate tax return and inaccurate financials. In this case, that discovery saved $30,000. And so what I really want you to do is think about your books, your financials, and be honest. And it's not a space to, you ain't doing this, you ain't doing that. That's not what this is for. This is for you to truly take a moment and think about your books and your situations. Are you reconciling your bank and credit card statements every month? If not, you need to. Are you separating your business and personal expenses completely? If you are not, you need to. And if you're someone who you use your personal funds to pay for expenses that are not running through any business activity, and so your accountant or bookkeeper has no clue what's going on, you need to make sure that you are keeping a list or somehow getting that information to your bookkeeper, because it's not that. And I think sometimes maybe people are maybe a little confused and they feel like, oh, if I pay for it out of my personal account, I can't take it as a business deduction. No, that's not true. You can, you just want to make sure that you have documented it. And that's what's going to be the most important thing for you. So that's why it's really great to make sure that you are separating your documents. And my last tip for you is, do not just use QuickBooks, review QuickBooks. A lot of my clients, they start out wanting to be in QuickBooks and they're not bookkeepers. I'm a CPA, I'm an accountant, I've been doing this for over 13 years. I don't get in QuickBooks. I don't fool around with QuickBooks. QuickBooks, you press one wrong thing and things get unreconciled and it's a mess. And so I don't do that. So you may be saying, well, what do you use? I use Wave. Wave is way more user-friendly to me, in my opinion. It's more user-friendly, especially as service-based business owners. A lot of times we don't have crazy transactions going on, and it's really simple for us to just use Wave, and it's free compared to QuickBooks. So that's what I have to say. $30,000 saved because of improper and inaccurate bookkeeping. We don't want that for you. The third blind spot that's costing people is missed or undocumented deductions. And I kind of touched on this a bit in the bookkeeping section, improper bookkeeping, because lack of proper bookkeeping will lead to missed and undocumented deductions. That's number one. And when I mentioned about when you pay when you pay business expenses from your personal account and then those kind of get missed because they were not on any of your business bank statements or credit card statements. And if you do not have a bookkeeper or accountant who's asking those questions, because I said, hey, did you pay any business expenses from your personal account that are not being currently reflected? I asked that question right off the bat because I see it so often that it gets done and I don't want to do that. And so number 3 is having these missed or undocumented deductions. And the crazy thing is most high earners, especially that I work with, they're usually missing like 5 to 15K in deductions. And it's not because they're necessarily doing anything wrong all the time. It's just they don't know. They're not aware that, oh, I didn't know that I could deduct that. I didn't know that I could deduct that. And so what having these missed or undocumented deductions could look like is you're not tracking or reporting your legitimate business expenses that you're actually entitled to. You're unclear about what qualifies, or you're afraid to take deductions in case it looks risky. And so you're just like, oh, I'm going to do it. I'm going to get in trouble with the IRS. You know, we go back to you're afraid of the IRS type of thing. You travel, learn, and market your business, but don't connect those docs at tax time. So when tax time comes, you're like, oh, I didn't know I could take those expenses. And so this is why it's really important to, again, make sure that you are tracking everything. I tell my clients, just write it all down. Let your CPA or accountant be the one to tell you, oh, no, you can't deduct that. Because what I'd rather you do is have it written down and not be able to take it than not have it. And then you're sitting here overpaying on your taxes like my client did. And this client, they were working with a CPA. And this I'm gonna get on the soapbox for a little bit. People, you hire a CPA and then you feel like that's the end all be all. That's not true. Not all CPAs are tax strategists. And I just want to say that because sometimes you feel like, oh, I did my job, I hired the CPA, but if they aren't doing certain strategic things, they just may not be the best person for you, especially when you're not someone who's super savvy and is going to be able to say, hey, take this deduction. Because I have some clients who they like to do the research about tax deductions and all that, and they really just want somebody to make sure that they're putting in everything correctly and things like that. They may can have someone who's not really being strategic because they're being strategic. But if you know that's not you and that's not your ministry, you really want to make sure that you are considering, is my CPA actually strategizing and being proactive with me, or are they being reactive or ignoring me in some cases? But anyhow, so my client was working with a CPA but was still missing expenses, telephone, travel, mileage. And by the time we added it all up, it was over $10,000 of additional expenses that had been missed. And so they were overpaying by $2,500 in tax. And you say, $2,500, that's not that much. Well, over 5 years, that's now $10K. That's $10K. And that's assuming that there wouldn't be more expenses in the future that got missed too. So the fix that I got with them is we identified the actual expenses and we actually considered what personal, it says personal expenses paid for the business, but it should have been what business expenses were paid by them personally. And then once I got answers about that, like I said, we uncovered $10,000 of additional expenses. And so what I want for you to do, especially as a service for provider, is think about what business expenses do you actually have that are required for your business, that are ordinary, necessary, and are you actually tracking them? Can you document it? And the questions you can ask yourself is, does it serve the business? Can you document it? And is it reasonable? And those are the things you want to be mindful of. And again, are you paying any business expenses from your personal account and making sure that you're tracking that, because you can record that in your financials. And some of the common misdeductions I see often is travel, airfare, hotels, rental cars, meals tied to your business activity, professional fees, coaches, masterminds, education related to growing your business, home office, mileage is huge. I see health insurance for self-employed gets reported incorrectly all the time. And even just changing that, I save clients thousands of dollars. So here's the thing. Your job is to make sure that you're documenting and writing everything down and making sure you're capturing. And then again, if you're not sure, write it down anyway and let your accountant decide. And I don't even want to say let your accountant decide, because that's tough too. Because if you're not dealing with a tax strategist, and they can actually see the business use of it, sometimes client CPAs or accountants will say, "Oh no, you can't deduct that." And then I get there and I say, "Well, wait a minute, did you go to this conference for primarily business?" And he was like, "Oh yeah, I was networking, I was doing this." I was like, "Oh yeah, you can deduct that." It is about, how do you document? That is what it's about. You want to make sure that you are documenting and making note of, why was this a business related expense? So that's another bonus for the things that you need to do to make sure you're documenting things properly. And this is a great segue into the fourth blind spot, and that's having the wrong accountant. It's like having the wrong partner. Come on now. I know someone's on here watching this and being like, "Ooh, girl, yes, yes, yes." Definitely the wrong partner will mess up your life, okay? So will the wrong accountant. Let's just say that. So will the wrong accountant. And so what it could look like is, you only hear from your accountant once a year during tax season. You're doing all the follow-up, chasing for updates, waiting weeks for replies. Yeah, I see that all the time with my clients. Or you're paying $300 for a tax return and calling it strategy. I'm going to hold your hand when I say this. And I need to make sure that, because my face I'm not sure my face is on this camera, but I need to make sure I'm holding your hand. So picture me holding your hand. If you are paying someone $300 to file your tax return, they are not giving you tax strategy. They are not. They are taking the information that you give them They are putting it into their software and they are giving you a tax return. I would venture to say if you're paying someone $500 to prepare your tax return, they may or may not be really giving you tax strategy based on your unique financial situation. Because tax strategy takes time and understanding about you, your goals, what you have coming up, what you've tried, what are your intentions, what's your cash flow like, so many different things to actually create a solid tax strategy. And that requires investment. It just does. And so I just wanted to make sure that my face was on this recording because I couldn't tell if it was or not. And I needed you to know that. Okay. So with that being said, um, typically you can tell if your accountant is really a strategist if they're asking you questions about your goals and actually creating strategy versus just data entry. And the reality is the lack of them being able to talk to you and have that guidance is costing you money. And I don't have a specific example for this because the truth of the matter is most of my clients, by the time they come to me, they have had the wrong accountant. They've had the wrong accountant. And whether that's because they started out with this accountant when the business was just starting and the business has really blossomed and they just never realized, oh, this accountant actually doesn't work for me. And then I think oftentimes is you don't know what you don't know. You a lot of times is, oh, the person is filing my tax return. I'm assuming that they're going to help me save on taxes, not realizing that tax preparation and tax planning are two different things. And it's not necessarily included in your tax prep. And most times it's not included in your tax prep because, again, it takes time, like understanding, okay, does your situation actually apply in here? Do you have everything necessary to document the deductions or the positions that you're taking? It's not something that's a super quick process. So most of my clients, like I say, by the time they come to me, they've been with the wrong accountant. And the problem that it leads to is overpaying in taxes, lack of peace of mind. They're wasting their time, energy, they've gotten penalties, you name it. And so what I do when I work with clients is during the intensives, I go and identify what would be the type of accountant that would probably work best for their situation. And then how do you go about hiring them, investing, figuring out what are the best questions to ask when you're looking for your accountant, what type of fee ranges can you expect, uh, and going from there. Now, of course, some of my clients decide that they will like to work with me, and that's not a problem. I do take on a limited amount of clients in that way. But even just having a blueprint, a roadmap of, oh, okay, this is what I need. These are things that I need to look out for. That goes such a long way. And I always tell people with your accountants and your financial advisors and things like that, these are your most intimate relationships when you think about it. Because as an accountant, we find out when you're married, when you're getting divorced, when you're having children, when your kids are going to college, when you have health issues, when you're retiring, like, and are you hearing major life events? That is the life with your accountant. And you mean to tell me that you just want to hire anybody for that? Absolutely not. You need to make sure that they are the right fit. So when we talk about what are the taxes saved, I think it's unlimited because it's not just your taxes. It's like other areas of your life that are being impacted. And so what I want you to do when you're looking out for an accountant is look out for strategic touch points throughout the year, not just at filing. Like if you only talk to your accountant at the time that your tax return is being filed, most likely they're not doing strategic tax planning for you. Because how are you doing that if the year is ended and now you're just talking to me? There was so much time to do planning, you know? And you want to make sure they're being proactive and offering you guidance, education on deductions, payroll, your cash flow. Now, I will say I said cash flow, but that can get into more CFO-ish. Now, I am someone who I look and pay attention to those things, but also I'm a certified financial planner, so that may be me being and doing the most. But at a very minimum, they're giving you guidance on deductions and payroll because that is part of taxes. And you want to make sure that they're being responsive. responsive. And I will tell you, there is a huge shortage in accountants, especially CPAs. I think it's like something like 40 or 50% of CPAs are retiring soon. And there are not enough new kids coming into the profession. So there is a shortage. And so what that leads to is a lot of times, especially if you're a good accountant, you are overbooked, you're busy, you're working until you start setting healthier boundaries. See, Alex Davis, she sets healthier boundaries. And so I have made it a point not to do that, so that way I can give my clients the most best attention with my clear mind and fast, right? I remember I was working with a client and she hadn't filed taxes in 3 years. And I'm talking about a seven-figure earner, hadn't filed taxes in 3 years. And in 30 days, we were able to get all her information together so that way she can get her taxes filed in 30 days. And this is after not filing for 3 years. And that is because I don't take on multiple, I don't overload myself. I cap out my tax clients. I work on 3 to 4 clients a month. That's it. So that way I can move through things fast. Because what I know is I tend to work with individuals who are a little bit of avoiders when it comes to this part of their money. And it's not something that they want to do. And so I find that if I give them a list of things to do, is, oh, I need to wash my clothes. Oh, I have to go to this house. Like all these different reasons not to just sit down and do the thing. And I don't want you to not do the thing. And so that's why I do that. But a lot of accountants don't. And so I share that because a lot of times there's just a shortage and people are not getting the support that they need. So you want to find out, what's the response time like? That's a lot. So let me know, how is this going for you? What have been your biggest takeaways? Which I think I have a slide about that. So let me keep going. Let me keep going. Okay, and in summary, so here are the blind spots. The wrong entity, on average, that could be $5,000 to $10,000. And this also all depends on your income, your situation. And I think some of these are small numbers compared to, especially some of my larger clients, some of the scary, crazy mistakes that I'm seeing that's costing a lot of money. But that could be 5,000 to 10,000 a year. And what is it really costing you? Restrictions on how fast you're growing, funding limits, that may change how much money someone's willing to invest or put in, and all those types of things. Improper bookkeeping, 8 to 12K. And that's like, you could be paying tax on money you haven't made. You're paying tax on money you haven't made. Let that sink in. We barely want to pay tax on the money we made. And when you have the wrong bookkeeping, inaccurate bookkeeping, you could be paying tax on money that didn't even hit your wallet. No bueno. Missed deduction. Missed deduction. That could be 3 to 10K a year in taxes. Money left on the table. No documentation trail. Like, it's not good. More money going to the IRS, not staying in your home. And the wrong accountant, I put down 2 to 5, but it's really unlimited, because here's why it's unlimited. Here it is. You've been vulnerable enough. You've shared all your documents. You're entrusting these people to prepare your tax return. And a lot of times, because we don't understand the actual scope of what we've hired someone to do, we're thinking that they've got my best interest at heart and they're doing the best. And I will say, I think most accountants are doing their best, right? But there is something to when you have been vulnerable, giving your information, and then someone doesn't do right by you, and now you've got penalties, you're overpaying in taxes, y'all, like, it's just, and that peace of mind that has kind of been ruined. Yeah, it's a big deal. So you want to make sure that you've got the right accountant. And so we're looking at $20,000 to $30,000 just from these 4 mistakes. I haven't even gotten into, some of the other, like, credits and things like that. So it's a big deal. It is a big deal. And so if you've been listening to this and you're like, wait a minute, I don't know if I'm in the right entity. My bookkeeping is, I'm not sure. I don't know if I'm missing deductions. My accountant definitely is no longer a fit for where I'm at. Then I have a question for you. We've been here before, haven't we? We've been in a situation where you're like, you got the tax bill and you're like, why do I owe so much tax? And instead of maybe doing some more research, getting a second opinion, you get caught up with life like we all do. You're busy again. And before you know it, it's February again. And you're like, oh, I have to get myself together to file my taxes. I don't have time to try and figure this out. And the cycle continues. And that cycle may be you paying an extra 10, 20, $30,000 of taxes. What would you do with an extra 10, 20, or $30,000 a year? I've got my ideas. And if you just want to throw away money, you need my Cash App, you need my Zelle. What do you need? I will freely give it to you. It's not a problem at all. Okay. But that's the definition of insanity, doing something over and over the same way and expecting a different result. And if you are now hearing me and you're like, I don't want the same result. I want more money in my pocket. I want to be like your client who took her $24,000 in savings, threw in some ads and tripled her revenue. Guess what? The opportunity is available for you. So now what? The first step is get clarity. The first step really is to get clarity before you try and like figure out all the strategies. Just get clear on what's necessary, what's needed, what's working, what's not, and what do you need to do to fix it. And so with that being said, I'm giving you an invitation. The information and link will be around here to book a money clarity session. The money clarity session is perfect for you if you're like, I have a specific issue that I want support with, and I just need your eyes on it and your professional guidance. I have a crazy special rate for you to get that get that question answered, because what I know is oftentimes we are not stepping in our full potential because we are nervous and afraid of, oh my gosh, I'm doing something wrong with my money. And subconsciously, it will not allow us to go to our next level. It just won't allow us to go to our next level. And then that you get that one question and now it's freed up. You got this weight lifted. You can breathe and you can soar. And that is what I would love for it to happen to you. So that was the money clarity session. And the beautiful thing about that is you book the session and then you realize, oh, actually, I want you to take a deeper dive with me and see what else might be there. Because with the money clarity session, you're telling me what the issue is and I'm helping you. With these other opportunities, the tax clarity intensive, that's when you're giving me the documents and I'm going through and I'm identifying everything, like all the blind spots, how to fix them, and even showing you how it's impacting you, so you can get out of the guessing game. Because I've had where clients come to me, they think it's one issue, and then when I actually look at the numbers, I'm like, actually, this was your problem, and it was a little bit bigger than you thought, but that's okay because I'm able to fix it for you. But either one of those, just DM me on Instagram if you have questions, and then the links for both of them will be around. And with the money clarity session, I think I started to say this and I got sidetracked. If you decide you want the tax clarity intensive and you realize that at the end of our call, and even like 24 hours later, you'll get just let me know and I'll give you a special code to use what you paid for the clarity intensive. You can just apply that to your intensive. So this has been wonderful, 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 wonderful. And so anytime you come into my world, I'm gonna give you some homework. What was your biggest aha and what did you learn today that would be most helpful for you and your business? And then what's one action step that you will commit to today? So is that going and reconciling your bank account? Is that saying, hey, you know what? Let me call 3 different accountants and set up appointments with them? Is it clicking the link to get your clarity session or your intensive with me? That might be it, because you're like, girl, I've tried it all. I just need to go ahead and come get with the best and save my 10, 20K. That may be something too. I don't know. Whatever is going to work for you. So yeah, that's all that I have for you today, but this has been an absolute, absolute, absolute pleasure. And again, if you have any questions, let me go back to this page. You can, of course, DM me, and yeah, let's connect. So have an amazing day, night, morning, whenever you're watching this.